The TPG net lease strategy really sits at the intersection of our credit and real estate businesses, where we believe we have the benefit of having strong credit protections and at the same time owning a hard real estate asset. The tenant gets to unlock the equity that's tied up in their balance sheet, and they do that by selling their mission-critical real estate, but they get to maintain control of that real estate through a long lease with extension options.
We're really excited to have closed Fund 5, right? Because now it's allowing us to invest in an environment which is as great as it's been in the last 10 or 15 years. We have a pipeline that's over several $billion, right? And our team has been actively sourcing those opportunities. I really think that this is going to be the best vintage fund that we have to date, given where the environment is today. Cap rates are at an all-time high, or at least a high in the last 10 to 15 years. Interest rates have now stabilized, which is important because it allows you to have a better idea of what the spread between your going-in cap rate and your debt rate is. And so now you've got, over $1 trillion worth of announcements from companies saying that they're going to reshore this production, and it's creating a lot of need for many, many more manufacturing facilities, either on a build-to-suit basis or buying facilities that are vacant, then improving them, and then doing sale-leasebacks.
Mission criticality is at the core of what we do from a diligence standpoint, and that tends to lead us to the industrial sector, where we believe there's just more natural downside protection by owning the mission-critical real estate. That will lead us to manufacturing, research and development, distribution and logistics, areas that we think are related to the supply chain, which we think provides tremendous downside protection in our deals.
Mission criticality is how important the sites are to the tenant. And that comes in a few different forms. First, how much revenue is produced at the site. The more revenue that's produced at the site, the more important the site is for the company. The more equipment that's at the site and the more investment they've made in this equipment, the more challenging it is for a tenant to move and the more likely they are to stay.
We have long leases and we expect to have a hold period that is longer than many of our competitors. So therefore, our exposure to these tenants is through many industry cycles. So it's very important to make sure that the long-term viability of this company is intact. We look at it from a credit standpoint, but we also have to look at it like an equity analyst and decide, is this management capable of enacting their business plan? And is it a good business plan? Is this company a low-cost producer or a value-added supplier? What is their value prop? And will it be necessary in this industry over a long term? Or are there disruptors that would make their role in the industry obsolete? All of those things we have to analyze on day one when we think about making the investment, because it's going to matter over a longer hold term.
TPG has been in the net lease business for 22 years. And during that time, we've built up, in my opinion, the best net lease team in the industry.
This is a time that we believe you want to have dry powder. We're very excited about the current opportunity set and the ability to deploy capital into one of the highest cap rate environments we've seen in our space. And we're able to do that with real duration, 20 to 25-year leases. So a very compelling time for our fund and for our investors. What excites us about this current opportunity set is the fact that relationships matter in the net lease space. And by being part of TPG, we have the benefit of leveraging decades of relationships across our private equity sponsors. And that allows us to source off-market opportunities, which we think can create compelling opportunities for our investors.